The plunge last Friday and Saturday vastly changed the technical map in Bitcoin. The key area of support that we've based our entire case on over the last few weeks was obliterated in a single blow. This spells trouble to anyone who comes unprepared. In our case, however, we have warned about a possible flat correction for quite some time now, and that flat is now more in the cards than ever before. Now, when drastic and unforeseen things happen on the market, I like to take a step back to thoroughly reassess the situation. For as you all know by now, we don't just do the regular type of bollocks TA, at which we change our minds entirely every second day. No, we build cases, and if one case in turn is made up from 50 components, then last week's drop removed half of those in one blow. And to be perfectly clear, we're not here to predict the future. We're here for no other reason but to identify lucrative low-risk spots to go long and short and high-risk zones to get the hell out of the way. And rather than rushing to the speaker's podium, I have really taken the time to come through those charts. In this episode, we'll go through those findings in detail, just as any new episodes in turn will add to our new case direction. This is a case at which we already have a lot of components. We have gone through the possibility of Bitcoin breaking through our key resistance cluster in several previous episodes. Now our job is to merely look at things from that very perspective, or bias if you may. And this, ladies and gentlemen, is the benefit of making cases rather than individual TAs. For as we broke through our cluster support, we knew already that it changed the picture altogether. And this is something we've been going on decisively about in the last few episodes. And this knowledge in turn makes us capable of getting out at the baby stages and at a minimum risk. And given that we already had a long-standing bear case, we can now keep on building onto that one instead. But before sinking our teeth into the juicy stuff, please note that nothing in this episode constitutes financial advice. I am not a financial advisor. And if this episode helps you better understand where Bitcoin is at, then please return the favor by hitting the like and subscribe buttons. It helps the channel grow so that more people can benefit from hearing our conclusions. Let's begin by looking at the daily chart and recap the situation. Bitcoin has broken through not only this cluster of support at $51,000 to $53,000, but also its leeway safety margins diagonal trendline on the regular chart, as in the arithmetic one. And while on this very chart, a particularly early worrying sign is that Bitcoin retested it up on its steep 4-day 25% dead cat bounce, after which it then got rejected. And as of producing this episode, Bitcoin has flung back and forth between the reliable EMA 200 on the daily for a few days already. And whether this holds up or not is written in the stars. Now, based on this high volume drop and retest of this diagonal trend line, does this automatically mean it's downhill from now on? Short answer is no, of course it doesn't, but it has dramatically altered the probabilities in favor of the bears. I've been called a perma-bear, typically by Bitcoin moonboys, but to be perfectly frank, I'm not biased. I'm just here to make money, and I can do that no matter where Bitcoin goes. But until Bitcoin reclaims some serious bullish ground, I'm not committing any more money to that cause. And as of yesterday evening, I'm all out of marathon for now. Anyone who follows me on AUGERE were notified immediately upon the decision. And if you want to take part in my trade setups and analysis there, then please sign up with the link in the description below. With that said, there are high risk to reward exceptions at which I will rebuy it all again. A lower bullish red closing in either Bitcoin or Marathon being one of them. But until that happens, I do expect further downside to follow. Much more in fact. But with that said, and to add some fine print, that doesn't mean we're gonna go straight down from now. For we can very well hover around sideways or in an upwards fashion before taking a steep nosedive to the south. Right, so we're currently trading below the key support cluster that we previously based our long position on. That cluster now acts as resistance. However, what does amaze me the most in this case is how I bought Marathon on Friday when Bitcoin still cost around $54,000 and how I still managed to get out at a 10% profit when releasing it all yesterday at $50,400 equivalent. But hey ho, I certainly don't complain. This is like stumbling on slippery ice and immediately strengthening your legs rather than breaking it. Or to be approached by a robber who gives you money at gunpoint. If we proceed to look at the RSI, we get further confirmation of why I wouldn't enter with longs under any circumstances yet. On the daily chart, it is now struggling to even break above the lower bullish red RSI line. And to those of you who know your RSI, an RSI that stays below the lower bullish red line is considered to be heavily trending with the bears. It's what we more commonly refer to as a bearish motorway. And for more on this, please watch the extensive RSI trilogy on this channel. Naturally, this in itself doesn't mean that the RSI cannot recover, but if we zoom on to the 8-hour and 4-hour charts, we can equally tell that they're both struggling in firm bearish blue RSI channels respectively. And what generally signifies a bearish blue channel is that any relief rally fails to bring the RSI past the upper bearish blue line, and if it does, it barely stays above for long enough to even catch its breath before plunging right back down again. But why stop there? For on top of the ever so weak RSI, we also have a fat bundle of moving averages right above us, tightly knit enough to act as an unleakable ceiling. For lo and behold, not much bullish sun will make it through this cluster resistance we're facing above. And this cluster in turn also consists of the horizontal resistance zone between roughly $51,000 and $53,000, as well as the diagonal resistance line that dates all the way back to the all-time high. And while on the 4-hour chart, whatever move we're seeing right now is a highly likely bearish continuation flag, for this is what we must statistically expect, as they are in fact continuations for as long as they no longer are. And so far we've had 3 of them already. So what on earth then should convince us that this time is the unlikely reversal exception? The only exceptions I will adhere to personally are RSI signals, and the reason for this is that they come at such low risk, and all the while at an uncanny and unparalleled ability to identify absolute lows or the very route between accumulations and markups. Yet with that said, I do expect the chance of a higher retest price to be the most likely case. If not, then we're talking some serious weakness that can take us down fast. And this alone is the reason why I chose to sell my marathon position yesterday, because I don't want to risk this being a short, tenaciously weak bear flag that will in turn plunge us down prematurely. But there are no guarantees whatsoever that we're gonna retest this zone before finding resistance. No, for in such case we could equally be in for something like this, as in some continued sideways movements that still won't take us any higher than we currently are. Hence, in that sense, the upside at this very moment is very limited, whereas the downside is much too big to risk. Now, if we proceed to the flat correction that we've been constantly keeping at the back of our heads for about a couple of months now, then this move and this 22 to 25% recovery, depending on what Bitcoin chart you use, more than well qualify for the first and second wave of the C waves total of 5. Now, depending on whether this prospect flat ends up being a running flat or an expanding flat, the ultimate target and its lingering way to get there may alter significantly. If we were to get a running flat at which we don't take out the A wave low, it naturally follows that the second and fourth wave recoveries may be longer, as well as each impulse down being of shorter nature. If we're in for a running flat, and if I know Bitcoin correctly, then we're not gonna stop the second wave at $53,000. Now, in such case, we may very well proceed to retest the $58,000 to $59,000 resistance area. Now, this would make sense on a lot of levels, because people would be trapped into thinking that Bitcoin is bullish again. Hence, it would punish a lot of people on its way down again. Hence, this here is certainly a scenario to keep in our minds, for Bitcoin is not by any means bullish until it takes out this zone and stays above it. If on the other hand we were to get an expanding flat, then each down impulse should be dire in its characteristics. And in such case, the third wave should be likely to end either at the key support at around 30,000, or it may find its way slightly back below and retest it again as resistance amidst its fourth wave correction, prior to rolling over like a dead whale towards the low to mid 20,000s. One thing that duly speaks in favor of a running flat being in play is this. Thus far we have a technically confirmed sideways range, however, to any sticklers out there it can also be drawn as a very lightly ascending channel. But as the angle is near negligible, whichever we ultimately choose will have little to no impact on our point here. For the point is that if we were to see a running flat, it is likely to finish somewhere between $29,000 and $36,000, depending on when it were to reasonably take place and depending on what scale it will adhere to, the log scale or the arithmetic one. But the main reason why I even bring this up is this. It has recently, from continuous empirical observations, struck me that a sudden steep price plunge like that from April to May, which in turn was preceded by an ascending channel like this, almost always go on to complete the range or channel in which it's in. Now, I have seen many renowned technicians, many of whom should certainly know better, who draw this here as an ascending triangle. But this here could never qualify for a triangle due to the huge empty space, and as a rule of thumb, if the texture much resembles a big wide U formation, then it is not a triangle in play. And the very reason why this is so important to bring up is because an ascending channel is bullish by nature. Hence, falsely basing our TA on an invalid formation will do a good job in itself in tricking us in the wrong direction. But more importantly, it will render us unprepared when something like this ends up taking place. And in such case, this is when their wake-up calls come way too late for them to react to it. As it stands, our main case now, based on the nullified price development over the weekend, is for a final price between $29,000 to $36,000. And depending on how the count looks, if it does promote a running flat, I will begin to scale in the low to mid 30,000s. If, on the other hand, the Elliott count instead justifies an expanding flat, then our long-standing target of $22,000 to $25,000 still remains.